Having studied the direct method of preparing cash flow from operating activity, the next step is to look at the indirect method. Now, let's have a quick recap of why do we call these methods direct method and indirect method. What I told you yesterday. If I were to ask you in a class of 15, tell me how many boys are there. What you would do is count 1, 2, 3, 4, 5, 6 and tell me the number of boys. That is direct method. Second method is from the total number of 50, you would remove everyone who is not a boy and then the number that is left with you would be the number of boys. So that is the basic idea. This method is the indirect method. Direct method, count the number of boys. Indirect method, from the total, remove everyone who is not a boy. What you are left with is the number of boys. Similarly, in the direct method of preparing cash flow statement, cash flow from operating activity in cash flow statement, what we did was we considered all items which were primarily instances of cash receipts in the course of your business operations and cash payments in the course of your business operations. Now, that was direct collection and direct payment, dealing in cash. But in indirect method, what we are going to do is from the bigger number called profit, we are going to remove everything that is non-cash. Naturally, what is left with her will be cash, and because we are calculating cash flow from operating activity, another thing that we will be doing is we'll be removing everything that is non-operating also. So it's not just the cash, it is not just the non-cash part that we'll be removing, we'll also be removing the part that is not operating. So once you have removed investing activity ka impact, financing activity ka impact, once you have removed all of these, the amount that you are left with is the cash flow from operating activity. Okay, so I'll just repeat the idea that I have in mind. What's the idea? The idea is take the total profit. From the profit, remove everything that is non-cash, remove everything that is non-operating. Naturally, what is left with you is going to be your cash collected in your operating activity, net cash collected or net cash used. We'll be understanding this in stages, step by step, so that you get a complete picture on how exactly is cash flow from operating activity estimated and calculated. Okay, pay attention here. We are now looking at the indirect method. Okay, now let's prepare a simple profit and loss account. Okay, a T-shaped profit and loss account. The total sales are 1 lakh and the total purchases or cost of sales are 30,000. Okay, let's see, let's even not make it cost of sales. Let us just say sales are 1 lakh, purchases are 30,000 and the profit that you are left with is 70,000. Now, there are a couple of basic assumptions that we are going to make. What are those? All sales are cash sales. That means there are no credit sales, and all purchases are cash purchases. Okay. No purchases on credit. All sales are cash sales. All purchases are cash purchases. That means the amount that is left with you. Okay. Cash flow from regular. What is 70,000? Profit of the business is 70,000. And since all sales are cash sales and all purchases are cash purchases, 70,000 also happens to be the cash generated from regular business operations. 70,000 also happens to be cash generated from regular business operations. So can I say, as a next step, can I say cash flow from operating activity? cash flow from operating activity would be, or cash flow from your regular business activity, there would be inflow 1 lakh minus outflow 30,000, net flow 70,000. Okay. Now this is all sales were cash sales, or all purchases were cash purchases. This was a very simplistic situation. Now I'm going to add one more layer of detail to it. I'm not calling it complexity. I'm just saying I will add one more layer to it. Sales and purchases. Same 30,000. And now there is an additional expense called depreciation worth 10,000. What you are left with is profit. How would you calculate profit? Sales minus purchases minus the amount of depreciation. All sales are cash sales, no credit sales. All purchases are cash purchases, that is no credit purchases. Okay. So what is my cash profit? My cash profit is sales, which is your cash inflow in this case, sales or cash inflow of 1 lakh minus purchases, that is cash outflow of 30,000. So cash profit is 70,000. But what is my overall net profit? Overall net profit is cash profit minus non-cash expense, which is depreciation, right? From my cash profit of 70,000, I subtracted depreciation, which is a non-cash expense, and I got my overall net profit. Overall net profit is 70,000 minus 10,000, that is 60,000. Now, to arrive at the figure of net profit, 60,000, I had to subtract a non-cash expense of 10,000. Okay. To arrive at the net profit of 60,000, I had to subtract a non-cash expense of 10,000. So, can I say that my overall net profit is cash profit minus depreciation or non-cash expenses? So can I just rephrase this a little and say that cash profit is equal to overall net profit plus depreciation, that is non-cash expense. So when I'm calculating my cash profit, what I do is to my net profit, I add the amount of my non-cash expense Q. While arriving at this 60,000, which was my net profit in the profit and loss account, while arriving at this 60,000, 10,000 was subtracted. 60,000 लाने के लिए 10,000 subtract किया था. What I need right now is I need my cash generated. ठीक है, my profit is 60,000, but this is profit after subtracting the non-cash expenses. Okay, this is profit after subtracting the non-cash expenses. To arrive at the profit of 60,000, I subtracted a non-cash expense of 10,000. अब मुझे I have to go back to the figure of cash generated. What I will have to do is to my net profit, I will have to add the amount of non-cash expense. So let's make a small rule here. ठीक है? The summary of case 2 or situation 2. To go from net profit to cash flow. ठीक है? Add non-cash expenses. ठीक है? अब while so when we had to calculate net profit, we subtracted the amount of depreciation. net profit निकालने के time we subtracted the amount of depreciation. So if I'm moving from sales minus purchases minus non-cash expense called depreciation, I arrive at net profit. I need the amount of overall cash generated. What I'm going to do is I will have to add the amount of non-cash expenses which I did here. Okay. Now let's add one more layer of information to this discussion. What is that? Everything else remains the same. Sales is 1 lakh. Okay. Then purchases are 30,000. Then depreciation is 10,000. After that, what do you have? You have interest on loan. How much? 5,000. And then you have net profit. How much? Net profit is 1 lakh minus 30,000 minus 10,000 minus 5,000. That is 55,000. To arrive at the figure of net profit, I subtracted depreciation, which is a non-cash expense, and I also subtracted interest on loan. This interest on loan is a non-operating expense, correct? What are operating expenses? Expenses that you incur for running your day-to-day business. What are the expenses that I incur for running my day-to-day business? Salary, purchases, rent, stationery, all of this. Interest is an amount I pay to the bank when I take a loan from the bank. Okay. So this is an outcome of the financing activity. This is not an outcome of your day-to-day running of business. So 5,000 of interest that we have subtracted, this is a non-operating expense. Okay, so let's just write it down to arrive at the figure of 55,000. That is net profit. We had to subtract 30,000 purchase cost, operating expense, 10,000 depreciation, non-operating expense, and 5,000 is interest on loan, which is depreciation is a non-cash expense, my mistake. Depreciation, which is a non-cash expense, interest on loan, which is a non-operating expense. We had to subtract from 1 lakh, that is sales slash cash inflow. Again, two of our basic assumptions continue to hold. What are those? All sales are cash sales, all purchases are cash purchases. Okay. So to arrive at the figure of 55,000 net profit, we had to subtract from 1 lakh 30,000, that is purchase cost, 10,000 that is depreciation, and 5,000 that is interest on loan. Subtracting purchase is subtracting an operating expense outflow. 10,000 depreciation is a non-cash expense. 5,000 interest on loan is a non-operating expense. But what do we need? We don't need net profit. We are interested in cash. We need to calculate cash flow from operating activity. So from Okay, we need to calculate cash flow from operating activity. If somebody has given you profit, okay, you are here 55,000. Where do you need to go? You need to arrive at the cash profit or cash flow of 70,000. Okay, you are standing at the net profit of 55,000 and you need to arrive at the total amount of cash generated. How will you do it? To this net profit, observe one more thing now. Overall net profit is cash profit minus depreciation non-cash expense minus interest non-operating expense. So cash profit will be overall net profit plus, see, you need cash profit. While arriving at net profit, you had subtracted depreciation and you had subtracted interest from the cash generated of 70. So if you have to go back to it, you will have to add back the amount of depreciation, non-cash expense, and you will also have to add interest, which is a non-operating expense. So the point that I'm trying to make is, what all items should you add back? While arriving at net profit, you had subtracted depreciation, which is a non-cash expense, and you had subtracted interest, which is a non-operating expense. So to go back to the amount of cash generated, add back the amount of non-cash expense, add back the amount of non-operating expense, and you will arrive at cash profit. So this is our rule number 2. Don't add just non-cash expense, add back the non-operating expense also. And now one last part. Sales 1 lakh, purchases 30,000, interest on FD 5,000, chalo 7,000. Net profit is 1 lakh plus 7,000 minus 30,000. Now 70 net profit of the business is 77,000, and to arrive at 77,000, we added 7,000 to 1 lakh and then deducted 30,000. Now see, 1 lakh and 30,000 are operating inflows, like relating to the main business activity. But interest on FD is not income from the main business activity. This is not the cash inflow from operating activity. This is not an inflow from the main business activity. What is this? This is an inflow from the investing activity. I put my money in a fixed deposit. On that fixed deposit, I earn interest of 7,000. So what is that 7,000? That 7,000 is inflow from investing activity. It is not an operating income. Okay? It is not an operating activity inflow. So what you should do here is, see, when you arrived at net profit, what was net profit? Net profit was sales 1 lakh minus purchases 30,000 plus interest of 7,000. Okay, so net profit is cash flow from operating activity plus income from investing activity. Yeah? Now I'm just changing the words here. Instead of saying net profit is cash flow from operating activity plus income from investing activity, I am saying this is income from non-operating activity or non-operating income. So now if I need just the cash flow from operating activity, what I have to do is cash flow from operating activity is net profit minus income from non-operating activity. Okay. So the third adjustment that we learned was income from non-operating activity has to be subtracted while arriving at the cash flow figure. So when I'm preparing the format for my cash flow statement and when I'm making cash flow from operating activity under the indirect method, what do? Profit before tax add non-cash expense, add non-operating expense, less non-operating income, the figure that you get is operating profit before working capital changes. Now, the term working capital changes is an important one. What are working capital changes? Working capital is basically funds that are required for running the day-to-day operations of the business. When you do financial management, you will learn more about working capital. But working capital is basically funds blocked in your day-to-day business activity, funds required for your day-to-day business activity. And naturally, the impact of this working capital on your business will have to be understood and identified, because again, this relates to the main business activity, right? So when I say working capital, what did I say? Working capital is the main or outcome of the main business activity, funds required for your main business activity. Think about the main business activity income side. On the income side, you have sales. If you have sales, there are only two outcomes. Either it will be a cash sale. So when you make a sale, your cash account will get affected. Or it could be a credit sale, which means when you make a sale, your debtors account will get affected. So in my balance sheet, the second impact of sales is recorded either in cash or in debtors. So to understand the cash flow from operating activity, I'll either have to look at debtors or I'll have to look at cash. Come to the expense list in your P&L. Think about purchases, think about salaries, think about all of these expenses, rent. When you pay rent, cash account gets impacted, there is a cash outflow. So you record that. Second item in this discussion would be the rent is outstanding or the creditors are yet to be paid. You have made a credit purchase. So when you, or salary is outstanding or rent is outstanding, which means the second effect of all expense items could either impact cash or it could impact current liabilities by creditors and all of these items. So whenever we are basically analyzing the impact of working capital, we are primarily looking at current assets and current liabilities. Okay, so let's start discussing all these items one by one. Let's talk about current assets. Maybe let's talk about debtors or short-term advances. Okay, now I'm going to discuss what. So let's assume that my opening balance is 10,000 and my closing balance is 8,000. Okay, opening balance is 10,000, closing balance is 8,000. Now, what could be the most logical deduction that you will make? Somebody tells you that the opening balance of debtors is 10, closing balance is 8. Your only logical conclusion is that 2,000 must have been collected from the debtors. So, when debtor balance decreases, the only logical conclusion would be that cash has been collected from debtors. Assume you have stock at the beginning of the year 10,000, stock at the end of the year 2,000. If I give you this information, what would be your first logical conclusion? Opening balance 10,000, closing balance 2,000. Your conclusion would be that we must have sold the inventory and we would have received cash. So the rule is whenever there is a decrease in current assets, it leads to cash inflow. Okay, whenever there is a decrease in current asset, it leads to cash inflow. Okay, now let's look at what happens when there is an increase in current asset. Let's flip the situation on its head a little, not much. Let's flip it a little. Okay, say the opening balance was 4,000, closing balance is 14,000. Now imagine that an employee comes to me, short-term advance, an employee comes to me at the start of the year and he asks for advance, I give him 4,000. Now he needs some more money, so I advance another 10,000 to him, and the closing balance at the end of the year is 14,000. At the beginning of the year or at the beginning of the month I gave you 4,000, so balance receivable at the beginning of the month was 4, then balance receivable at the end of the period or end of the month was 14, and the only logical explanation is that additional loan or additional advance must have been given to you. So when receivable balance increases, the first logical conclusion would be that we have given additional money to the person. So basically, whenever there is an increase in current asset, whenever there is an increase in current asset, it leads to cash outflow. Okay. So this is my second rule. Whenever there is an increase in current asset, it leads to cash outflow. I'll give you a trick also to remember how this works. But I would want you to understand the impact of movement in current assets principle, or the idea, the logic behind it. Whenever there is a decrease in current asset, opening stock 10,000, closing stock 4,000, my conclusion is I would have sold the inventory and received cash against it. So decrease in current asset leads to a cash inflow, and increase in current assets leads to a cash outflow. Let's talk about current liabilities. What are our current liabilities? Say, assume that it is creditors or advance received from someone. Okay. Now, the opening balance and closing balance situation is given to you. Okay. The opening balance is how much? Opening balance is 10,000, closing balance is 8,000. At the start of the year, in my books of accounts, 10,000 was appearing as a payable. At the end of the year, in my books of accounts, 8,000 is appearing as payable. What does my common sense tell me? Payable balance has gone down. Why would it go down? There is a very little chance that the other party will say, Arey Satyamed, I forgive you. Don't pay me anymore. That is rarely going to happen. If the balance has gone down, in my opinion, the only logical conclusion would be I have made a payment to the supplier or I have made a payment to the creditor. So when payable balance gets reduced, the only logical conclusion is that cash has been paid to the creditor or supplier. So what is the rule? The rule is that whenever there is a decrease in current liabilities, it leads to cash outflow. And let's look at another situation. Opening balance 10,000, closing balance 8,000 in current liability. Let's flip it a little. I'll flip it this way, not too much. Opening balance 4,000, closing balance 14,000. Now, at the beginning of the year, in my books of accounts, there was a payable by the name Ayush. 4,000 was payable to him. We arrived at the end of the year. Now I see that 14,000 is payable to him. Why would the payable balance go up? Not out of thin air. Ayush must have given me some more loan or some more advance during the period, which is why the balance went up. So, whenever payable balance goes up, the only logical conclusion would be that we have received more advance or more money from the supplier. Okay. So what is the rule? The rule is whenever there is an increase in current liability. Okay. Whenever there is an increase in current liability, it leads to cash inflow. Okay. And we'll be combining this together as a rule. Okay. I want you to remember just one of the four treatments. Okay. Current asset decrease. Think of inventory, opening balance 10, closing balance 4. Inventory balance has reduced. Only logical conclusion is I must have sold the inventory and received cash. So current asset decrease, inflow, add. Up. Current asset. Decrease ka change it to increase. Naturally, everything would be opposite. Outflow, deduct. Then current liabilities. Now, current liability increase. If current asset ka increase was an outflow, current liability ka increase would be inflow, add, and current liability. If current liability ka increase is an inflow, then current liability ka decrease would be outflow, that is deduct. Remember current asset, decrease, inflow. So now if instead of decrease, the current asset increases, naturally it will lead to an outflow. A current asset decrease is an inflow. Current liability decrease. Asset ke jagah liability. Naturally, it will be an outflow. So just keep these basic things in mind, and you have the entire rule made out for you in terms of which items have to be added and which items have to be subtracted. So what does this look like? The format for cash flow statement using the indirect method: profit before tax, add non-cash expenses, add non-operating expenses, less non-operating incomes, you get operating profit before working capital changes. Then this rule: add decrease in current asset, subtract increase in current asset. Just remember that decrease in current asset is to be added. A current asset, instead of decrease, if you change it to increase, naturally it will have to get subtracted, opposite. After doing this, the figure that you will arrive at is cash flow from operations. From the value of cash flow from operations, subtract the amount of interest paid, subtract the amount of tax paid, you will get cash flow from operating activity. That is the starting point. Okay, so this is how you would calculate the cash flow from operating activity using the indirect method. Now, after this, what we are going to do is we are going to do two full length questions which deal with cash flow from operating activity, or rather the entire cash flow statement to begin with. Let's have a look at the first question. This is a proper full length question which requires you to prepare a cash flow statement. All three activities, operating, investing, financing, have to be considered. Now, whenever you prepare any financial statement, balance sheet, P&L, cash flow, one thing that always helps is going to the adjustments first and identifying which all items have an investment, so you can be careful about those. During the year, Firework disposed of several items of plant and machinery, loss on disposal, depreciation charge, loss on disposal included in cost of sale. Basically, so you don't need to understand the full adjustment. Just use this time to identify the items which are going to be impacted. One, items of property, plant and equipment disposed of, loss on disposal, depreciation charge means property, plant and equipment, and that is included in cost of sale. So this will be impacted. Then Firework company estimated that income tax liability arising on the profit is so and so. So income tax liability is here. Okay, so again, what is this? This is also another item which is going to be impacted. So you know that these are two or three areas which have a direct adjustment given. Other information we'll see as we process. Now, my approach in such questions is that I either go in the order of adjustments and close everything that is given in the adjustment first, or I go in the sequence given in the financial statements. You can do both, you can do either, that depends on you. I would prefer starting in the order of adjustments, as in making sure that everything relating to adjustments, I have written that in one place, I have tackled all the effects, and then I move to the actual individual balance sheet and P&L. Now they are saying that during the year ended 30th June 2005, Firework Company disposed of several items of plant and equipment for sale proceeds of 80. Loss on disposal was 20. It is included in cost of sale. Depreciation charge for the year is 1.5 crores. Now let's start here. Property, plant and equipment has an opening balance of 93,000 and a closing balance of 1,10,000. So create a ledger for property, plant and equipment. On the debit side, opening debit balance on the debit side. So to balance brought forward and by balance carried forward. What is the amount of balance brought forward? 93,000. And what is the closing debit balance? Closing debit balance is 1,10,000. Okay. Now you have posted these two items, put a tick mark so that you know you don't have to come to these numbers ever again. Now, during the year, Firework Company disposed of several items of plant and equipment for sale proceeds of 80 lakh. Loss on disposal was 20 lakh. So, sale proceeds 80 lakh, but because all numbers are in thousands, that is what we are going to do. We are going to convert this to thousands. And what is loss on disposal? 20 lakhs. So sale proceeds are 80 lakhs. Loss on disposal is 20 lakh. That means what must be the carrying amount of the asset sold? So this means carrying amount of assets sold must be 8,000 plus 2,000, that is 10,000. Okay, so an asset with this particular value was sold. Now you'll have to, I always prefer recording the accounting entry. What is the accounting entry for this transaction? The accounting entry is by bank account debit. Okay. How much is getting accumulated in the bank account? You are getting 80 lakhs. Okay. Then there is a loss on disposal, debit all expenses and losses. So by loss on disposal account debit, how much? 2,000, and credit what goes out? The non-current asset is going out. So to non-current asset account credit. Itna 10,000. Now go to the credit side of this account. Write down by bank 8,000 by loss on disposal 2,000. Now, what they are saying is that the loss on disposal is included within cost of sales. Now, I'm sure you would agree with me when I say that loss on disposal is a non-cash item, correct? It is also a non-operating item, but primarily it is a non-cash expense, non-cash item. Okay, so that is one thing. The 8,000 is cash received on disposal of the asset. So that is cash inflow from investing activity. Okay, so you have taken care of this, and then depreciation charge was 1.5 crore. So what will be the entry? See here, if you observe the asset side, they have not deducted the amount of they have not shown accumulated depreciation separately, which means the asset is already at its carrying amount. See, had they shown the accumulated depreciation separately, that means that would have meant that the asset is at cost. But because they have not shown the accumulated depreciation separately, that means the asset is already depreciation has not been recorded in accumulated depreciation account. The entry has been depreciation account debit to non-current asset. So what we are going to do is we are going to record the depreciation entry for this by depreciation account debit to non-current asset account. This is the accounting entry. Okay. Depreciation account debit to non-current asset. Post it here on the credit side by depreciation account 15,000. So effectively in this process, what you have done is adjustment number one, all the entries and all the effects you have given impact to. Now ensure that you give the result or you give the impact in the cash flow statement as well. Okay. So cash flow from operating activity, where does it or what does it start with? It starts with profit before tax. Whatever that number is, we'll pick it up later. Right now, you are supposed to add non-operating slash non-cash expenses. Non-operating expenses are loss on disposal. This is a non-operating expense and depreciation is non-cash expense. Okay. So loss on disposal 2000, depreciation 15,000. So this is taken care of. This is taken care of. 8,000 is the amount of cash received on disposal of the asset. So what you are going to write here is you will write down proceeds from disposal of asset. कितना? 8,000. Okay. Now ये हो गया. So put a tick mark here to tell yourself that yes, this adjustment has been taken care of. Now the second one, Firework estimated that income tax liability arising on the profit for the year ended 30th June 2005 was 65 lakh. Now income tax opening balance 10,000, closing balance 6,500. So provision for tax opening balance is opening credit balance, write it on the credit side by balance brought forward and to balance carried forward. Opening balance brought forward is 10,000, closing balance carried forward is 6,500. वो लिख दिया आपने. And Firework estimated that income tax liability arising on profit for the year was 65 lakh. That means profit earned this year, उस पे you are supposed to pay a tax of 65 lakh. So that is current year का tax expense. The accounting entry for that would be tax expense account debit to provision for tax. Okay, so you will credit provision for tax account by writing tax expense. This is expense for the current year. So this is some also. Now you have posted this and you have posted the ledger balances. What are we saying now? What we are saying is opening balance, opening payable 10,000. Then during the year, whatever profit you earned, on that profit you are supposed to pay a tax of 6500. So you recorded an entry tax expense account debit to provision for tax, and then closing balance is your 6500. That means the amount is still payable. So where will the balancing figure go? The balancing figure would be to bank. Balancing figure. Okay. Now let's take the total also here. Your account has been effectively closed and settled. So 6,500, 10,000, and this has been taken care of. This has also been taken care of. Now let's start to move line by line and see when all the items in the balance sheet and P&L are handled, naturally your job will be completed. Correct? Current asset hai. Here you have already written non-operating non-cash expenses. I'm doing less non-operating incomes as per our format. Okay, non-operating incomes होगा तो देख लेंगे. After that, what you will get is you will get operating profit before working capital changes. Okay, now you have to deal with individual items. Opening 30, closing 36. Decrease in current assets is added, which means increase in current asset is subtracted. Okay, so write down increase in or less increase in inventory. How much? 6,000. Tackled inventory. Put a tick mark. Then trade receivables. Opening 35, closing 40. Increase in current assets is subtracted. Less increase in trade receivables. How much? 5,000. This is also taken care of. Don't do anything to cash and cash equivalents because ultimately uska difference is what you are trying to find out. The whole exercise is happening for that. Then equity share capital opening 15,000, closing 20,000, and share premium opening 3,000, closing 8,000. That means some more money has been raised by way of equity share capital, which is why the share capital and the share premium balances have increased. The only reason for increase in equity share capital would be that company has issued more shares and received cash against it. Same thing goes for share premium, because when would you receive share premium? You would receive share premium only when shares are issued and cash is received. So this has gone up by 5,000, this has gone up by 5,000. So total 10,000. Come here, cash flow from financing activity, write down proceeds from issue of equity shares, 10,000. Okay, so equity share capital, share premium, then the next item in the balance sheet is reval surplus. Opening balance 8,000, closing balance 10,000. That means some non-current asset must have been revalued. The entry is non-current asset account debit to revaluation surplus by non-current asset account debit to revaluation surplus 2,000. So post it on the debit side of non-current asset account. यहाँ पे लिखो to revaluation surplus 2,000. Okay, so this is also dealt with. Retained earnings. Opening balance 85, closing balance 96. What is my profit for the year? My profit for the year is 25,000. So I have an opening balance of 85,000. Profit for the year after deducting all expenses, income tax and everything. Profit for the year is 25,000. So opening balance of retained earnings. Itana 85,000. Add profit earned during the year. Itana 25,000. That means closing balance should have been कितना चाहिए था closing balance? Your closing balance should have been 85,000 plus 25,000, that is 1,10,000. ये आपका balance होना चाहिए था. This should have been your balance. How much is your balance? Your balance is 96,000. Now why would retained earnings go down? it could go down in two circumstances: A, when you have suffered a loss, and B, when you have paid out a portion of that profit to the shareholders in the form of dividend. Now, see, in this case, there is no loss. Very clearly, the question says there has been a profit. So, the difference between what should have been the balance and what is the actual balance is your dividend paid. Actual closing balance is 96,000. Difference is dividend paid. Again, I will repeat. Opening balance of retained earnings is 85,000. You earned a profit of another 25,000. That means the closing balance of retained earnings kitna hona chahiye tha? How much should it have been? It should have been an amount of 1,10,000. But actual kitna hai? 96,000. So why is the balance in your retained earnings lesser? The only explanation for this is when the company has paid a dividend. So there is a hidden adjustment. This is not a direct adjustment. This is a hidden adjustment. And payment of dividend is cash flow under financing activity. So here write down payment of dividend on shares, working note 4. Kitna? Minus 14,000. Okay. So this is dealt with. Now, you had an opening bank loan of 17,000, closing bank loan of 7,000. The one explanation I could get is that I must have repaid the loan. So, repayment of loan. Itna? Minus 10,000. From 17, you have come down to 7. Now, talking about current liabilities, trade payables have gone up from 30,000 to 36,500. There has been an increase in trade payables. Increase in current liabilities is added back. So here, add increase in trade payables. How much? 6,500. This is the amount of increase in trade payables. ठीक है, तो ये भी लिख दिया आपने. Basically, you have now knocked off every single item in the balance sheet. Apart from, of course, cash and cash equivalents, that is what you have set out to do. उसी का difference ढूंढना है आपको, right? So you have given effect to all the items in the balance sheet. Now this income tax also you have dealt with. ठीक है, अब your starting point should be profit before tax, that is 31,000. ठीक है. Now loss on disposal ये सब हो गया. Now what you will get is, come here, interest payable 750, administration expense 1,000, distribution cost 3,000. Interest payable. Interest is an expense, but it is a non-operating expense. So all non-operating expenses have to be added back. Also, as you can see, यहाँ पे there is an interest expense, but there is no interest payable. What does that mean? That means the entire amount of the interest has been paid off. Entire amount of interest has been paid off. Okay, so there is nothing to show as payable at the end of the year. So again, this item will be added. Interest on loan, how much? 750 would be the amount of interest on loan. ठीक है. नॉन ऑपरेटिंग इनकम चेक करो, कोई है क्या? नो, देयर इज नो नॉन ऑपरेटिंग इनकम. ये लिख दिया 31,000. प्रॉफिट बिफोर टैक्स ये लिख दिया 750. Now, just one thing. I think I made a mistake here. Okay. I'll get back to the mistake. Just 1 minute. Let's talk about it first. Firework estimated that income tax liability was 65 lakh. When it says that the income tax liability was 65 lakh, I did not read the word. I just was in a hurry. when they say income tax liability has been 65 lakh, that is the closing balance. But यहाँ पे if you observe, income tax expense is 6,000. So tax expense to tax provision should have been for an amount of 6,000. You see, this is a silly mistake that has happened because we did not read the question correctly, which again brings us to the same point that reading the question is super important. Now, I'm not going to act over smart and say, "Ki, "Arey, I was trying to see whether you are able to figure it out." I am telling you, we made a genuine mistake. We should have been more careful, which is something that I would want you to keep in mind always. Okay, now this is the amount of tax paid. How did you get 6,000 from? You got your 6,000 from here. There is no non-operating income, as you can see. So, what you are left with now is operating profit before working capital changes. How much is that? 48,750. The number that you get here is cash flow from operations. 48,750 minus this plus this 44,250 less interest paid. How much? 750. How do I know 750? Okay. Now there is interest expense in P&L 750 and there is nothing payable. Had any amount been payable, we would have written it in the balance sheet. They would have shown it. If nothing is given, that means there is no payable and that means the entire amount of interest has been paid off. Less tax paid. 9,500. I'm repeating for those who have not paid attention, or I'm repeating for those who might have forgotten. Interest payment is usually shown as a cash outflow under, or ideally should be shown as a cash outflow under financing activity. But IAS 7 gives you a choice. It says you can show it under operating, you can show it under investing, sorry, you can show it under financing, but your IFRS material or ACCA material expects you to show it under operating activity. Hence, we have shown it there. No other reason. Okay. So that gives me my cash flow from operating activity. Let's see how do I get that number. Cash flow from operations minus interest paid minus tax paid, I would get 34,000. Now we have still not closed this particular account. Let's see how to close this. To bank, that would basically show you the amount spent on purchase of a new asset. Okay, 1,35,000. 40,000 is the amount of cash that has been spent on purchase of a new asset. So write it down here. Amount paid for purchase of asset. Kitna? Minus 40,000. This gives you cash flow from investing activity 32. You already have cash flow from financing activity 14,000. What is net cash flow during the year? A plus B plus C. Operating 34 minus investing 32 minus financing 14. Net cash flow during the year is minus 12,000. That means your balances fell by 12,000. Now observe what is the opening balance. Opening balance is 10,000. Write it here. You had an opening balance of 12,000. It decreased by 12,000. That means you have negative 2,000. And negative 2,000 is bank overdraft. Bank overdraft has a credit balance. This 10,000 had a debit balance. It was an asset. Here, bank overdraft has a credit balance. So 10,000 debit balance minus 12,000 gives you negative 2,000, which is credit balance and which is your answer. Okay. This is how you would get the closing balance of cash and cash equivalents. So this, guys, is exactly how a cash flow statement is supposed to be prepared using the indirect method. Now, a this is a long question. I'm repeating. Preparation of the entire thing is not going to be tested. If you are writing the diploma IFRS exam, preparation of cash flow statement full length is not expected. If you are writing the ACCA SBR exam, again, preparation of full length cash flow statement of a standalone entity is not expected. But when we do consolidated cash flow statement, this knowledge is going to come in very, very useful. Plus, even in your professional career, understanding and preparation and interpretation of cash flow statement is very important. Hence we decided to do one full question on how to prepare a cash flow statement. Okay, one more full length question on preparation of cash flow statement. Again, we'll have to use the indirect method. Now look at the adjustments. Cracker disposed of some item of plant and equipment. Okay, plant and machinery, where do I have? Yes, property, plant and equipment. Depreciation loss was देखते हैं. Cracker company estimated that income tax liability was this much. Something to do with this. Let's close these accounts first. Okay. Now, for non-current assets, I know that there is an adjustment. Okay. Create your non-current asset ledger. Here, see whether you have any accumulated depreciation. No. That means the depreciation has been credited to the asset account. 70,500 and 73,000 are your carrying amounts. Okay. They are after depreciation. Opening debit balance on the debit side. यहाँ पे write down to balance brought forward 70,500. Sorry. 70,500. And what is the closing balance? It is a closing debit balance 73,000. Closing debit balance on the credit side. So by balance carried forward 73,000. Posted. Okay. Then during the year, Cracker disposed of plant and machinery. The carrying amount of these items on the date of disposal was 8 lakh. Okay. The amount of plant and machinery disposed of, the carrying amount of the item disposed of was 8 lakh. The depreciation charge for the year was 5 lakh. Now, you see here, in this question, if you observe, in the adjustment part, they have not given you whether there was a profit on disposal or loss on disposal. So see whether you get that information from the P&L. As you can see, there is a profit on disposal of plant 300. Okay. Carrying amount of the item was 800. So carrying amount of asset sold 800. Okay. And what is the profit on disposal of plant and equipment? Profit on disposal of asset is 300. So what I need to understand is, if carrying amount is 800 and the asset was sold and there was a profit on disposal of 300, then how much money would I have received on disposal? So my disposal proceeds are 800 plus 300, right? जब मैं 800 का asset I will sell at 1100, only then I will have a gain of 300. Now, with that in mind, let us proceed to record the accounting entry. Accounting entry होगा by bank account debit. ठीक है, you have gotten 1100 in your bank account. 1100 to non-current asset account. Bank account debit to non-current asset 800 to profit on disposal. Credit all incomes and gains. 300. Bank account debit to non-current asset account to profit on disposal. This is the accounting entry. So in the non-current asset account on the credit side, write down bank account कितना 800. यहाँ पे create an account called gain on disposal or profit on disposal. ठीक है, create an account called profit on disposal. अब बैंक अकाउंट डेबिट टू नॉन करंट असेट टू प्रॉफिट ऑन डिस्पोजल, यहाँ पे लिखो बैंक कितना 300, and naturally when you close this account at the end of the year, entry will be profit on disposal to P&L. So your P&L account will be credited with 300. Now if you must observe, this is a non-operating income, this is not an operating income, this is a non-operating income. Bank account debit to non-current asset to profit on disposal. Okay, so let's see if there is anything else. Yes, there was depreciation charge for the year of 5 lakh. What is the accounting entry for depreciation? Accounting entry for depreciation. Most of the times we record depreciation to accumulated depreciation. But here there is no accumulated depreciation. Asset is shown at carrying amount. So you will credit depreciation account debit to non-current asset 300. So by, I think it's not 300. Let's see. Let's check that for ourselves. It is not 300, it is 500. ठीक है, 500 लिख दो. This is wrong. This is 500. Okay. Now you shouldn't ideally close the non-current asset accounts right away, because there might be some entries that you will have to deal with later. Maybe there is some other adjustment which is not directly given to you. For example, revaluation. But don't break the chain. Continue what you are doing. Okay. But just make sure that you have posted the impact of all of these items. I prefer posting it immediately so as to avoid any mistakes in the future. So, first thing that I would want to do is cash flow from operating activity, profit before tax, add non-operating non-cash expenses less non-operating incomes. What are non-cash expenses here? Depreciation. How much? 500. In non-operating incomes, you have profit on disposal. Write down profit on disposal minus 300. Okay. Now, cash flow from operating activity, so that's the final number. But in cash flow from investing activity, I think we also need to write down the amount of cash that we have received on disposal. So, proceeds from or proceeds on disposal of asset. Asset बेचने पे कितना मिला? 1100. So, write it down as an inflow. You have done all the impacts. Just check it once. Non-operating incomes minus 300. Non-cash expenses added. Proceeds from disposal written. So you have given all the impacts. Now, income tax. Opening payable 2310. Provision for income tax. Opening credit balance on the credit side. Buy balance brought forward 2310. And closing balance 2900. Closing credit balance on the debit side. To balance carried forward. How much? 2900. You have posted the balances of income tax provision or income tax payable. Now, Cracker Company estimated that income tax liability arising on the profit for the year ended was 29 lakh, and the amount of income tax expenses also 2900. So what would have been the entry? The entry would have been tax expense account debit to provision for income tax. Okay. So you will write it here. How much? You will write by tax expense account 2900. Okay. And the balancing figure would naturally be the amount of tax paid to government. So just write down to cash balancing figure. How much? 2310. Okay. So even this has been dealt with. And just write down here in operating activity less tax paid. How much? 2900. I think 29023. 2310. Sorry. 2310 is the amount of tax paid. So just write that down. Now, that is also taken care of. Now come to your balance sheet P&L and start posting items from there. Just for your reference, you have given effect to this. Yeah, matlab, the tax payment figure you have calculated. Where would you want to start from? Follow one sequence always. I have ticked off one item here. I would as well complete the balance sheet adjustments. Opening balance of inventory 25,500, closing balance 27,500. There has been an increase in the amount of current asset. Increase in current asset is subtracted. Less increase in inventory. Kitna? Minus 2,000. Okay. Then trade receivables were 33,000, increase to 37,500. Increase in debtors. Increase in current asset is subtracted. So minus 4,500. Less minus 4,500. Taken care of, taken care of, done, 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 and done. Cash and cash equivalent is what we are interested in finding out. So no point in including that. Equity share capital opening 10,000, closing is 11,000. No opening balance for share premium, closing is 610. That means the company must have issued equity shares at premium during the year and raised money by way of equity share capital. This is cash inflow under financing activity. 1610. So proceeds from issue of equity shares. So closing balance of equity shares 11,000, opening balance 10,000 plus share premium also 1610 is the amount raised. This, this handled, handled. Okay. Now we saw there was a hidden adjustment with respect to retained earnings that gave us the dividend figure. Let's evaluate whether a similar situation arises here or we are good to go. Opening balance of retained earnings 66,040. Okay. So opening balance of retained earnings 66,040. Add profit for the year. How much is profit for the year? 8750. 8750. So that means closing balance of retained earnings should be कितना होना चाहिए closing balance of retained earnings 74,790. How much is it? It is 74,790. And closing balance of retained earnings is, that means no dividend paid. Okay, fair enough. But you have tackled everything now. You have tackled all the balances of retained earnings. You have checked for any hidden adjustment that you have gotten rid of. So ये भी हो गया अपना. Now, non-current liability. Opening balance of debentures 20,000. Closing balance 23,500. That means you raised more money by way of debentures. How much? 3,500. So proceeds from issue of debentures 3,500. Okay, this is also done. Look at current liability. Opening balance 31,900, closing balance 29,450. So 31,900 minus 29,450, that is 2,450. This is a decrease in current liability. You should subtract. So here less decrease in trade payables minus 2,450. So this is also tackled. So all items in the balance sheet have been given effect to. Now come to P&L. What is your starting point? Your starting point is profit before tax 11,650. Okay, 11,650. Then you wrote this interest payable. Interest is a non-operating expense. Add back interest here. 2,150. Okay. Then investment income 320. Investment income is a non-operating income. Subtract non-operating incomes. Investment income 320. Okay, so that is also posted. Profit on disposal you have considered. You will arrive at operating profit before working capital changes 13,680. So after that, what do you have? You will get your figure of cash flow from operations. How much would that be? 13,680 minus this, minus this, minus this. 4,730. Now, tax paid you have already written. See, had there been any interest payable, it would have shown on the liability side of balance sheet, but you don't see any interest payable. That means this entire amount has been paid. So, less interest paid minus 2,150. Okay, and now you will get your cash flow from operating activity, which is 270. Now, investing activity, what all you should be looking at? In case of investing activity, there is proceeds from disposal of asset 1100. See here, there is investment income. Investment income could be dividend, could be interest, could be anything. Now, had this been receivable, so you would have seen this on the current asset part in the balance sheet, but you don't see it. That means this entire amount has been received. 320 investment income has been received. So just write it down. Investment income 320. This is an inflow for me. Now look at my non-current asset account. I have posted all the entries. Now I need only look at the calculation of the balancing figure. How much is the balancing figure? The balancing figure is 3800. This is my naturally amount paid for purchase of new asset. Okay, this is my uh, amount paid for purchase of new asset. So purchase of new asset minus 3800. What is your cash flow from investing activity? Minus 2380. 5110 is cash flow from financing activity. Take the total of the three. Operating A, investing B, financing C. The total is 3,000. What is the opening balance? Opening balance of cash and cash equivalents is 1250. No overdraft on the liability side. So just take 1250 and voila, you have closing balance of cash and cash equivalents, and therefore your entire activity has proven to be super successful. Whatever numbers you applied, whatever logic you applied, that has helped you to get the desired final answer. So this is how you prepare a cash flow statement using indirect method. My recommendation to all of you would be to watch the recording carefully and try to redo the two questions that I have done in the recording, so that you get that comfort over preparation of cash flow statement. And That's it. That's for cash flow statement. This is now going to help you later much more when we do consolidated cash